Hey everyone, it's Alex from Tori Investors. Welcome to episode 2 of Investing 101. Today we'll be talking about the different type of investment vehicles. So we're going to start with bank savings. Bank savings are a very conservative investment vehicle. They typically pay a relatively low interest rate, though typically greater than zero. But one nice thing about bank savings is that they are liquid, meaning that you can access the money at any point in time and very quickly. Second type of account to discuss are CDs. CDs are also a banking instrument that provide a slightly higher interest rate than bank savings typically do. The only catch when it comes to CDs is that typically you have to commit to investing your money for a specific amount of time. Some CDs are short-term with a duration of only a couple of weeks or months, and some CDs are long-term with a duration of multiple years. The next type of account we review are bonds. Bonds are also a conservative savings vehicle. When companies need to raise money, one of the ways they do so is by issuing out bonds. As an investor, you can buy bonds with the expectation of receiving the interest that the company promises when they issue the bond. Next investment vehicle we'll talk about are stocks. Stocks represent partial ownership inside of a company. Stocks are considered an aggressive investment because the price can fluctuate on a day-to-day basis. The next type of vehicle we'll talk about are mutual funds. Mutual funds are essentially large bundles of individual stocks and/or bonds. Typically, mutual funds are made up of 50 to 150 different securities, and mutual funds are run by professional managers. Typically, mutual funds are created to pull together the money of investors with similar goals. The last type of investment vehicle we'll talk about are ETFs, or exchange-traded funds. Exchange-traded funds are somewhat of a hybrid between mutual funds and individual stocks. They're similar to mutual funds in that they're made up of a bundle of securities. However, they're also similar to stocks in that they are traded on a stock exchange like stocks are. One difference between ETFs and mutual funds is that mutual funds typically have a high level of active management, meaning a lot of buying and selling of securities is going on within the funds. ETFs are typically run formulaically with not a lot of active management and trading going on inside of the funds. This begs the question, which type of investment vehicle is right for you? Mostly it depends on your investment goals as well as your time horizon. If you need help deciding which accounts and which vehicles work best for you, consult your financial advisor. Stay tuned for next week for episode 3 of Investing 101. Thanks for joining us today and have a good one.